Could it be that the most important part of crypto isn't the flashy headlines around Bitcoin or the cutting-edge tech behind Ethereum, but the boringness of stablecoins? No hype, no volatility, just a digital dollar that works, and is already transforming how people send money, store value, and run businesses around the world. In this video, I'll show you how stablecoins are quietly becoming one of the most powerful tools in global finance. Let's start with what stablecoins are actually doing in the real world, because this isn't about hype, it's about function. Say you're sending $200 from New York to a relative in Manila. Through a traditional bank, that money snakes through a maze of correspondent banks, eats up fees, and takes days to arrive. Your family might only receive $180 after 3 to 5 days. Now, swap that for stablecoins. The same transfer arrives within minutes, and the fees drop to just 2 to 3%. That's why by 2025, stablecoins now power nearly 1 in 4 global remittance transactions. In Africa, more than half of recipients now say they're getting remittances through crypto. Why? Because it just works better than banks. And it's not just personal payments. In places like Argentina, where inflation hit 143%, saving in pesos is like watching your money melt. Today, over 60% of Argentina's crypto volume is in stablecoins, mostly USDC. Small business owners in Buenos Aires use USDC to store value and keep online payments stable. And in Nigeria, Turkey, and across sub-Saharan Africa, this same pattern is spreading. Stablecoins as an inflation shield. But they're not just for saving. Businesses are using stablecoins to pay suppliers, especially when banking access is limited or costly. A textile shop in Lagos can now pay a manufacturer in China using USDT instantly. That improves cash flow on both ends. No wire fees, no middlemen, no delays. Even companies in volatile economies are pricing goods in dollars locally, then instantly converting to USDC behind the scenes. It's a hedge against currency collapse. Stablecoins aren't just functional. They're becoming mainstream. Apps people already use, like Telegram, with nearly 1 billion users, now let you send USDT directly inside chats. No crypto wallet required. Binance Pay supports USDC payments at over 32,000 merchants worldwide for everything from flights and groceries to luxury goods. Even Visa and Stripe are in the game. Visa expanded its cross-border pilot using USDC, while Stripe acquired a stablecoin infrastructure company for over $1 billion. And this isn't just early adopter behavior, and adoption is growing fastest in emerging markets. Mobile-first platforms like Coinbase Wallet and Trust Wallet are driving that growth, helping onboard people who've never had reliable banking in the first place. This isn't crypto speculation. It's real money movement, with stablecoins filling gaps that traditional finances still can't. The rapid rise of stablecoins isn't just a payment story. It's a monetary story. In countries where stablecoins are widely adopted, they created a new kind of digital dollarization, where people abandon their national currency and hold digital dollars instead. The upside, more financial stability for everyday people. The downside, local governments lose control. When stablecoins like USDC and USDT circulate broadly, central banks can't steer monetary policy as effectively. Inflation-fighting tools weaken, and in some cases, countries may feel pressure to peg their currency to the dollar just to keep up. The European Central Bank even warned that if dollar-backed stablecoins spread too widely, it could weaken the euro's influence and limit the ECB's ability to manage the economy. Meanwhile, stablecoins are starting to look like a faster, more accessible version of the euro-dollar system. Offshore dollars that never touch the US banking system, but power global trade. That comparison has big implications, both for US dominance and for countries trying to maintain their own financial independence. With hundreds of billions of dollars now moving through stablecoins, the big question becomes, can we trust them? That's where regulation and reputation come in. In July 2025, the US passed the Genius Act, the first federal law governing stablecoins. It requires issuers to back every token one-to-one with safe assets like cash and US Treasuries. It also forces transparency. Issuers must publish monthly reserve reports, and large players face full federal oversight. The goal? Keep stablecoins stable and avoid another FTX-style collapse. But not all stablecoins are created equal. USDT, or Tether, is still the largest by far, over 150 billion in circulation. But its history is murky. It's never been fully audited, and critics still question the makeup of its reserves. USDC, by contrast, is smaller, but more transparent. Issued by Circle, it publishes detailed monthly reserve disclosures, backed by audited treasuries and cash. USDC is the preferred choice for institutions, regulated platforms, and DeFi apps, while USDT dominates in global trading, remittances, and emerging markets. In many ways, they reflect two competing philosophies. USDT prioritizes access and scale. USDC leans on trust and compliance. And with regulation ramping up globally, the rules may soon favor the stablecoins that play by them. Stablecoins might not grab headlines like Bitcoin or Ethereum, but they're solving real problems for real people. From helping families avoid inflation to powering international payments in minutes, they're not just a crypto experiment. They're becoming financial infrastructure. And with regulation now catching up, their role in the global economy is only going to grow. If you want more content at the intersection of macro and crypto, subscribe to the Keynesian Ledger. Thanks for watching. I'll see you in the next one.